What if the greatest transfer of power in modern history didn't happen through war, conquest, or elections, but through debt? What if nations didn't fall because they were invaded, but because they borrowed and never stopped? And what if, every time a country went deeper into debt, someone else quietly won, without appearing on any ballot, without firing a single shot? Today's story is not about borrowers. It's about those who win when nations borrow forever quietly. Debt did not always rule nations. For most of human history, governments borrowed only in emergencies, wars, famines, disasters. Debt was temporary. Repayment mattered. Default was shameful. But something changed. Over the last few centuries, a new financial architecture emerged, one where debt was no longer a last resort, but a permanent feature of governance. Entire economies were redesigned around borrowing. Interest became normalized. Deficits became routine, and repayment? Quietly postponed? Indefinitely. This system didn't arise by accident. It evolved through banks, central institutions, financial markets, and policy decisions that promised stability but delivered dependency. To understand who wins, we need to follow the story from the beginning. The roots trace back to early sovereign lending in Europe. Monarchs borrowed from wealthy families to fund wars. When kings defaulted, lenders demanded power instead of repayment, tax rights, trade monopolies, political influence. Then came a turning point: central banking. With the creation of institutions like the Bank of England, governments gained the ability to borrow continuously. Debt could be rolled over instead of repaid. Old loans were paid with new loans. Interest became the true product. This was revolutionary. Governments no longer needed to fully repay debt as long as they could service interest. That single shift changed everything. Fast forward to the 20th century. After world wars and economic crises, debt exploded. To manage it, countries abandoned hard money and adopted fiat currencies, money backed not by gold, but by trust and government promise. Central banks gained extraordinary powers, creating money, setting interest rates, buying government debt. Now governments could borrow from markets that knew repayment wasn't required, only continuation. And here's where the quiet winners emerge. Every time a nation borrows, bondholders earn interest. Banks earn fees, financial institutions gain leverage, currencies lose purchasing power slowly. The public sees infrastructure, social programs, or stimulus. But behind the scenes, debt becomes an asset for the few and a liability for the many. At first, debt feels painless. Growth hides the cost. Inflation is subtle. Elections pass, but eventually the math asserts itself. As debt grows faster than productivity, governments face a choice: raise taxes, cut services, print more money. Most choose the third. This leads to inflation, not as an accident, but as a release valve. Inflation quietly transfers wealth, from savers to borrowers, from wages to assets, from the public to those closest to money creation. Debt doesn't disappear. It's diluted. When nations borrow forever, ordinary people pay through reduced purchasing power, higher living costs, shrinking middle classes. Meanwhile, those positioned near debt issuance, large financial institutions, asset holders, global lenders benefit. They don't need nations to repay. They need nations to continue. Permanent debt means permanent influence. Policy decisions shaped by markets. Governments afraid of bond yields, sovereignty constrained by credit ratings. The winners remain largely invisible because the system appears normal. Governments try fixes: austerity, debt ceilings, bailouts, restructuring, but each fix treats symptoms, not cause. The cause is structural, a system where growth depends on debt, and debt depends on confidence, and confidence depends on continued borrowing. Breaking the cycle would require political sacrifice, financial reform, and public awareness, none of which benefit those who profit from the status quo. So the cycle continues. Governments try fixes: austerity, debt ceilings, bailouts, restructuring, but each fix treats symptoms, not cause. The cause is structural, a system where growth depends on debt, and debt depends on confidence, and confidence depends on continued borrowing. Breaking the cycle would require political sacrifice, financial reform, and public awareness, none of which benefit those who profit from the status quo. So the cycle continues. First, debt is not neutral. It redistributes power. Second, inflation is not random, it is a consequence. Third, those closest to debt creation benefit most, while those furthest pay quietly over time. Warning: open-ended thought. If debt defines the future, Then understanding who benefits from it becomes a civic responsibility, not a financial hobby. The real danger isn't borrowing, it's borrowing forever, without asking who's winning. If this changed how you see national debt, like the video. If you want more deep, cause and effect stories about money, power, and systems that shape our lives, subscribe. And ask yourself next time you hear about a national loan, who wins quietly when nations borrow forever?